तू स्टॉक्स में इन्वेस्ट करती है?
हाँ बिल्कुल, सब है मेरे पास। रिलायंस, HDFC, ICICI, SBI सब खरीद रखा है मैंने। एकदम डाइवर्स पोर्टफोलियो है मेरा।
Did you notice what was wrong here?
Most people think owning a lot of names is the true diversification. But look closely. Reliance, ICICI Bank, SBI, they are all a part of the same economy, same economic structure. This means same market, same risk, same downfall. So the moment market crashes, all of them come burning down to the ground. It's like saying that you have a variety in your diet because you eat aloo paratha, chips and fries. But actually, sab jagah aloo hi hai. Real diversification isn't about how many names you own, but how they all behave when the market conditions change. When the markets fall, the equity investments take a hit, but bonds, they might stay stable. Gold might actually go up. This is called uncorrelated movement. This is exactly what protects your portfolio. Because if everything in your portfolio moves in one particular direction, you have just built yourself a domino setup, which is not actually good. Now let's get practical. How do you actually build a diversified portfolio? Let me give you some actionable tips. Number 1, diversify across multiple asset classes. Don't just depend on equity and mutual funds. Mix it up a little bit. Equity for the long-term growth. Bond investments, possibly through mutual funds, for steady and stable income. Gold to hedge against inflation and market crashes. International assets so that your portfolio doesn't only depend on the Indian equity market. And at last, cash or liquid funds for emergency consumption. Think of it as your financial thali. You can't survive on one sabzi alone. Second, diversify even among the asset classes. Even within equity, don't just stick to large cap, but also buy some mid-cap, small-cap and even international allocation. Within debt, balance short-term and long-term papers. This reduces your concentration risk because one bad performer wouldn't pull down your whole ship. Number 3, don't overlap mutual funds. Most people invest into 5 or 6 mutual funds that hold the same top 50 stocks. This is not diversification. That's duplication. Stick to 2 or 3 mutual funds with distinct investment styles, like maybe one large cap fund, maybe a flexi cap, and maybe one international allocation. Number 4, rebalance regularly. Your ideal portfolio mix today wouldn't stay ideal for all the time. Let's say those equity investments shoot up and now become 80% of your entire portfolio. It's time to book some profits and bring it down to your target, say 60%. That's also how you lock gains and control risk. Number 5, match all of this diversification with your financial goals. Your retirement portfolio should look different than your short-term emergencies. Your child's education fund needs a separate mix than what your travel bucket needs. Diversification doesn't mean random spreading, but purposeful allocation. And that's where a lot of people go wrong. They focus on number of products, not the purpose behind them. At Fincart, we focus on building that purpose-driven mix. Not just a portfolio that looks good on paper, but one that actually protects your future. Our constant reviews help you to assess which assets balance each other, when to rebalance the portfolio, and how to align everything to your goals. So the next time someone comes up to you and says, "Mera portfolio to fully diversified hai," ask them whether it's diversified by numbers or by nature. Because having many things is easy. Having the right things, that's what diversification's true meaning is.